மார்க்கெட்டோட நிலவரம் மேல போகும் கீழே வரும். இந்த ட்ரெண்ட் எல்லாம் பார்த்து ஆசைப்படாதீங்க. கொஞ்சம் கொஞ்சமா நீங்க பண்ணுங்க இன்வெஸ்ட். கனவு எல்லாம் நினைவாக்குங்க, இதுதான் பெஸ்ட். ஸ்மார்ட் மற்றும் சிம்பிள் பிலாசபி. ஸ்மார்ட் மக்களுக்கு இதுதான் ஐடென்டிட்டி. டெஸ்ட் பண்ணு நீ, ஸ்டார்ட் பண்ணு நீ. சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான்ஸ் அண்ணா சொல்றத கேளுங்க. அண்ணா ஸ்மார்ட் ஆகுங்க. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. பண்ணணுமா 350cc சவாரி, இல்ல செகண்ட் ஹனிமூன்ல ஆப்பிரிக்கன் சஃபாரி. கட்டணுமா ட்ரீம் ஹோம் இன் டவுன் பேமெண்ட், இல்ல செக்யூர் பண்ணணுமா ராக்கிங் ரிட்டையர்மெண்ட். பிளான் பண்ணணுமா உங்க ஃபாரின் ட்ரிப். நான் செய்ய வேண்டியது ஸ்டார்ட் செப். ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு. ஸ்மார்ட்டா வேலை பண்ணு, SIP ஸ்டார்ட் பண்ணு.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயங்களுக்கு உட்பட்டவை. முதலீடு செய்யும் முன்பு திட்டம் சார்ந்த ஆவணங்களை கவனமாக படிக்கவும்.
मार्केट्स की लकीर कभी ऊपर कभी नीचे, कभी होना ना फिदा इन ट्रेंड्स के पीछे। छोटी छोटी किस्तों में करो तुम इन्वेस्ट और बड़े बड़े सपने जियो, क्योंकि ये है बेस्ट। स्मार्ट और सिंपल फिलॉसफी, स्मार्ट लोगों की यही है आइडेंटिटी। टेस्ट कर ले तू, स्टार्ट कर ले तू सिस्टमैटिक इन्वेस्टमेंट प्लान्स। भाई सुन मेरी बात, भाई बन जरा स्मार्ट। चल कुछ स्मार्ट कर, SIP स्टार्ट कर। चल कुछ स्मार्ट कर, SIP स्टार्ट कर। करनी हो 350cc की सवारी या सेकंड हनीमून पे अफ्रीकन सफारी। भरना हो ड्रीम होम का डाउन पेमेंट, ये सिक्योर करना हो एक रॉकिंग रिटायरमेंट। प्लान करना हो अपना फॉरेन ट्रिप, ऑल आई नीड इज टू स्टार्ट अ सिप। चल कुछ स्मार्ट कर, SIP स्टार्ट कर। चल कुछ स्मार्ट कर, SIP स्टार्ट कर। चल कुछ स्मार्ट कर, SIP स्टार्ट कर। चल कुछ स्मार्ट कर, SIP स्टार्ट कर।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
So, good evening to all of you. Welcome to the ICICI Pro and BusinessLine jointly hosted webinar. This is the 10th and the last part of the investor education series that we've been doing over the last few months. Even as COVID has struck us, we've stayed at home and we've been very happy to see the kind of participation we've received for these webinars. So, in this 10th episode of the Smart Investor series, we are looking at a subject which is very close to the hearts of first-time investors. So far we've covered some slightly esoteric topics like risk management in debt funds and asset allocation, etc. But we found that there are a lot of new investors, youngsters who've just joined jobs, etc., who are getting very interested in the equity market. So this webinar is specifically directed at these people. So if you've been reading the pink papers and the financial press, you would have noticed this new trend called Robinhood investing, right? So in the US, there's this discount broker called Robinhood who offers very low brokerages. And this has led to tens of thousands of new investors entering the stock markets in this particular bull market. So India too has seen its version of this Robinhood investors, in the sense that if you look at the data from the depositories, in all the months between June and October, every month, more than 10 lakh new Demat accounts have been added to the kitty actually. So today the number of Demat accounts in India is close to 5 crore. The number of mutual fund folios is close to 9 crore. And actually the folios, if you remove duplicate accounts, etc., you may actually find that the number of mutual fund investors is slightly lower than the number of stock market investors. This is a slightly upside down kind of phenomenon. So We have with us Mr. Abhijit Shah from ICICI Pru Mutual Fund to discuss what first-time investors should know about mutual funds versus direct stock investing, what can be done to improve their return experience in mutual funds, how the onboarding process and the digital experience has changed in recent years, and issues like this. So, Mr. Shah has warned me that I should keep his introduction very short and sweet. So, I'll only say that he has over 20 plus years of experience working with various financial services brands like Citibank, ING, Vysya, Standard Chartered, before he actually joined ICICI Pru Mutual Fund in 2014. He's head of marketing and is in charge of the customer and digital experience at ICICI Pru Mutual Fund. So this webinar will be structured as a conversation between me and him. And of course, we'll be very happy to take viewer questions at the end of this short chat that we have planned for you. So on to you, Mr. Shah. So my first question is, yes, we've been seeing a lot of these additions to Demat accounts showing that a lot of first-time investors in India are actually entering the stock market for the first time. And for some reason, they are preferring to go straight into direct stock investing instead of coming via the mutual fund route. So what are some of the advantages of actually taking the mutual fund route as opposed to directly going and buying stocks in the market?
Yeah, hi, Aarti. So thank you very much. Firstly, I must congratulate Hindu Business Line for this wonderful initiative to get investors under this forum and talk about various topics. And we at ICICI Prudential Mutual Fund are really excited to partner with you and tap into the expertise of the entire Hindu Business Line team, so that investors are actually aware, not only aware, but get educated in what they are doing and how they're looking at their investing experience, etc. So to your particular question, Aarti, I think, ma'am, we've seen COVID-19 has really changed everything around us. I mean, there was a world pre-COVID, and then there's a world post-COVID, right? I think the in-COVID moment has just kind of merged into a post-COVID world and given rise to various things like work from home, which maybe like a year back or a year and a half back, if somebody would have asked me that can the office really function from home, I mean, people would have said that you must be joking, because how can that be possible? But people have just adapted to that. You see a lot of people doing various things. So the work from home also has, like we see in the trends, led to a new phenomenon called trade from home, or invest from home, right? So people are, especially a lot of youngsters, are looking at stock markets, are looking at alternative investment avenues to kind of park their surpluses or to meet their goals, and as important tools for their financial planning journey, which is a very encouraging trend, first of all, because all of us know that capital formation is an integral part of any economy, and more and more money that comes into capital markets is always good for the economy on the whole, right? Now, while investors and while people have looked at the stock markets on their own, the only point that we make an appeal to investors is that, and that's what comes in all our communication, saying mutual funds are subject to market risks, and read all offer documents carefully. But a trend that happens is when people look at stock markets, direct investing, etc., you don't really have that disclaimer. But everything is actually to do with the markets, and market risk is a reality. And understanding market risk or investment risk is the pivotal part of any investment journey. So, like a broken record, we keep on telling investors that while you are doing it on your own, and DIY is a great approach to investing. Please also look at one's risk profile. Please also look at what is the time horizon that you are investing at. Please also look at companies, or please also look at sectors that you're getting in. And unlike unlike Amazon, wherein a lot of people buy something and recommend something, I would strongly say that each risk profile is very different. Each each one's time horizon is different, and one should kind of look at one's own risk appetite. How much money is one willing to put risk, and what are the return expectations before investing. And classically, mutual fund is a vehicle that does all of this for investors. And there are various types of mutual funds and in various asset classes, for various time horizons, for various risk profiles, and it is well regulated from a investor protection point of view. So there are experts who are doing it. So while you are doing and learning that, the need to also look at experts and try and kind of diversify into products is very very real. So that's what we tell investors that, and what's really happened, if you and if you look at March, is when the markets were at an all-time low.
That's
and,
right.
and if you look at now, the markets are at an all-time high. So the line is only been straight and upwards, right? But that does not happen in any market cycle. And when the time period increases, there is bound to be volatility. There is bound to be a downtrend, because markets go in various directions. So again, the need to really understand what one is doing with one's own hard-earned money, rather than just doing it from a hobby or from an excitement perspective.
Right. So that reminds me of a quote, what you said. I mean, it is easy to confuse a bull market with your own genius. So usually, since March, what has happened is it's been very easy actually to identify outperforming stocks in the market. And many stocks that you pick just by chance have turned two baggers or three baggers. So this bull market has made it look as if choosing stocks is a very easy affair. But as somebody who's invested in mutual funds and stocks for the last 25 years, I mean, when the cycle turns, I can tell you it can get very, very difficult to actually hold on to your sanity, because you don't know which stock will correct and which will hold on, etc. And the other thing we are noticing in the market is that the sectors that outperform keep rotating. So a few months back, it was all about NBFC stocks. Before that, it was pharma stocks. Now it is metal and mining. So by owning your exposures through a mutual fund, I think you get three advantages. One is you don't have to devote so much time to reading balance sheets, researching companies, checking out their management, governance, etc. So the fund manager does it for you. Secondly, when the market flavor or the earnings picture changes, the fund manager will churn the portfolio. You don't have to do anything. You can just sit tight. And thirdly, in phases like bear markets, I've seen that typically some of the badly performing stocks can lose even 80 to 90% of their value. So from the 2008 peak, if you had picked real estate stocks or infra stocks, many of them fell 90%. And with a mutual fund, even a badly performing mutual fund, the downside can be substantially contained because it is a diversified portfolio of stocks and not a single stock that you're holding. So these are broadly the reasons I have found for actually having an allocation to mutual funds. Because, and also, unlike COVID times when all of us have a lot of free time on our hands, on an enduring basis, I think all of us are quite busy. We don't have that much time to look into stock markets. So it's almost a full-time activity to be direct investing in equities, actually.
Yeah, I completely agree with you, ma'am, because what you're pointing out, which is the crux and the core of the value proposition of mutual funds, or the asset management industry as such, which is focused on process and not only the outcome. A lot of times people believe that the past outcome is going to sustain, and and it and like you pointed out, it's definitely never a one-way street. So the focus on process a lot of times ensures that the outcome is also favorable, right? Or to that extent, it is definitely in line with one's investment objective. And it is not like when the market really corrects, your portfolio is also correct, because there is a lot of thought that goes into it, research that goes into it, a lot of diversification that goes into a
Yeah.
portfolio, right? In terms of getting various sectors, etc. So you are not really exposed to the downturns in a manner. And yeah, like we saw, right, and which you were mentioning, saying it is never about the past. If one were to really look at IPL performances, and sorry that I'm quoting cricket, because today it is the most trending topic in the country. If one were to only look at IPL performances and the performances people did on the Dubai track, which was more or a Sharjah track where IPL was played right now, which is more a flat track, and selected a team and did not focus on the process. You saw what happened today in terms of when the track is different, when the opposition is different, right? So process orientation is really important.
Yeah, that drives home a very important point that past performance of stocks also is no indicator of their future. So you cannot just pick stocks which have done well in the last 10 years and hope that they will continue to be the outperformers. So there's a lot to stock picking which involves forecasting, looking at how businesses will perform, etc., which is not everybody's cup of tea, actually.
Yes.
So that brings me to the next thing. So typically, when you talk of mutual funds, in most beginners seem to equate it only with equity mutual funds. But suppose I'm worried that today's stock market is at very high levels, and still I want to invest in some market-linked fund, where I will get decent returns. What are some of the other categories of mutual funds I can look at beyond these pure equity funds that are there?
Yeah, that's a very valid question that each investor and most investors ask us today, saying, okay, what now, or what
Hmm.
next? Where, okay, I mean, I am in pure equity, or I'm not, or people, largely a large set of investors who say that, hey, look, I missed on this rally.
Yeah.
What do I do now? I think our answer is very clear, that it is not only about one asset class, because making money is all about asset allocation, and we are big believers, and more, classical investing, and most people who made money across market cycles will swear by the asset allocation methodology, because not one asset class does well all the time, and there are opportunities available. So asset allocation. So by asset allocation, I mean that there are funds that invest dynamically into asset class and move that money into the other asset class. So, for example, if equity markets are overvalued, if then the fund allocates a portion of that money into debt, or vice versa. And within equity markets, also the funds pick on various sectors or various companies which provide value basis their price to book, or various models that are there. So asset allocation, I would say, is a good starting point for people who believe that markets have picked, and what do I do with my money? Another way to look at it is staggered approach of investing. So systematic investment plan is a great option for people who have a discipline. So what an SIP does is buys at various market levels. So that gives you the advantage of rupee cost averaging, meaning you buy market, or you buy the buy the fund at various levels, and on average your returns are then compounded. It also instills a power of discipline, rather than waiting for the market to correct, or waiting for the right opportunity. Because you enter at various points in time, that's automatically taken care of.
Yeah. In fact, yes, if you go by valuations alone, for quite some time, the markets have looked a little expensively valued. So if you kept waiting, also, you will keep missing the market. And then typically, when a fall happens, also, you would never know where the bottom is. For example, in March, a lot of people were thinking that there is further downside in the market, but this market just had a V shaped recovery from there. And many stocks have gone up so sharply that it has been difficult to catch them, right? So to avoid this FOMO feeling, it is good that if you continue with your SIPs and have a very non-emotional approach to investing, right?
Yes.
Yes. So, what are some of the fund categories apart from equity funds that investors can look at? Yes, one way to manage risk is asset allocation. So, you say that out of every rupees 100 I have, only 50 I will put in equity and 50 I will put in debt funds or gold. But apart from that, what are the categories which you can look at? Yes, you spoke of dynamic allocation, but there are others also, right? Like hybrid
Yes.
equity.
Absolutely. So, I mean, as an industry, because we are regulated by Securities and Exchange Board of India, there are various categories of funds, and the categorization is decided basis the risk profile of each and every fund mandate that we have. So, equity is one category where people pure equity funds have various subcategorizations, right? A blue chip or a large cap kind of a fund. Then there is a mid cap, which invests as a mandate into medium-sized companies, and then there is a small cap fund, which invests into small and micro companies. That's on the equity side. On the debt funds, there are various funds which invest into various debt market instruments, like money market, like your government securities or corporate debt, etc. So there are various categories under debt funds, and then you have your hybrid funds, which is a combination of debt and equity, which at a pre-stated level has a static debt and equity portion, so investors can choose from them.
Right. So one other this hybrid equity which you mentioned is particularly useful, I found, because it does this automatic rebalancing whenever the market gets overheated in equities, and it moves the money into bonds. And bonds also in India actually tend to give very good returns. So over the long time period, actually, these hybrid funds tend to give very decent returns with less volatility for investors. Right?
Yeah, as a category,
Yeah.
balanced advantage funds or dynamic asset allocation funds is the category which automatically move between debt and equity depending upon market conditions, depending upon valuations within and various asset management companies have various models.
Right.
But that's a category that really adds advantage to or a balance to the portfolio.
Yeah. So today, if you are a new investor and you're watching the equity market go up, you want to participate, but at the same time you're worried about valuations, then these two categories are really good ones to step into through SIPs, of course, hybrid as well as
absolutely, and subject to your own investment risk appetite.
Right.
Subject to, and sorry, we keep on bringing that again and again because we firmly believe that it is the investors' hard-earned money, and since the topic is about investing experience, it is, and that's our fundamental belief that especially for first-time investors, it is very, very, very important to understand what the investor is buying or what the investor is investing into, because it's as simple as that, right? If my first experience with any product is not going to be great, I would really rethink or not buy or not invest in that category or not look at that instrument. But that is the larger risk, ma'am, and I think you should, from your experience, highlight that, because it is never about timing the market. It is always about time in the market. And as we see, a lot of people are starting early. It is not only about the early start, but staying in the market for a longer period of time, right? So with a negative experience in the beginning, The last thing that an investor wants is miss out in participating in the equity markets or debt markets, or the whole financial markets from a long-term perspective, because the power of compounding is, as somebody mentioned, the eighth wonder of the world. And if that does not kick in early, then people miss out. So the FOMO is not really about investing now or not, but a larger FOMO is if you don't invest in the right category, right fund, and be left out after 10 years, when as opposed to your friend or cousin who did the right thing and is financially secure much before you.
Yeah, so one thing I have observed is when markets are really high like this, people tend to look for quick gain opportunities. So they go into thematic funds, or they go into small cap, or without really understanding the risk profile of the category. So in 2000, for example, many of the equity funds were very IT heavy and people did lose a lot of money. So since then, regulations have also been fine-tuned a lot to make diversified equity funds truly diversified in nature. And today, actually, if you stick to a hybrid equity category or a dynamic allocation, the risks are far more contained by the asset allocation and their stock-specific limits than was the case in those days, actually. So
yeah, I think the regulator has done a fantastic job of categorizing each and every category from a risk profile point of view, since you mentioned that, ma'am. And from a communication of that risk also, it is very transparent. And even if you don't really really go through in detail, at a headline there is something known as a riskometer for every mutual fund product that you have, which is not there, by the way, for a stock that you buy directly, because nobody's really done the research, or there's nobody's really put that on that. So one can really look at the level of risk, and it is all color coded with an arrow. So there are enough data points and enough information mediums that help investors to decide. The only point is one has to really look at it and be disciplined and take a very informed decision.
Yes. So from performance, let's come to the other less talked about reason to invest in mutual funds, which is the convenience factor. So one reason why during these lockdown months it has been quite easy to keep up with your SIPs and other things is the fact that today actually the mode of investing for the mutual fund investor also has become very easy, right? For example, the onboarding process through which the investor gets on to his first mutual fund. How has that changed over the years, and how simple has it become? Can you tell us?
Yeah, so earlier, as you see, not only for mutual funds, but most financial products, most products, because, digitization has really put out the benefits of frictionless or onboarding for every product. And the consumer today, customer expectation is also really high when it comes to buying any product. So financial services is also moved. The regulator has done a lot of work to ensure that it is easy, frictionless. So you can go to any mutual fund site, or you can go to any mutual fund distributor, and there are tools, digital tools available for onboarding. Like a simple link comes to you, you click that link, you show some of your documents, or you upload some of your documents, and the onboarding is very easy. And the best part is if you open a folio, which is our account equivalent, or if you open a mutual fund account or a mutual fund folio with one asset management company, you don't have to go and do the onboarding process again with other mutual fund companies. So that's a big big convenience, and you get your KYC done once, and then you can just basis your PAN number, which is your unique identity, just code that at a different asset management company, and you don't need to really do your KYC or the onboarding process again, and you just start buying. So that's
I remember in these even 10 years ago how difficult it was to actually get into every new mutual fund, because you had to give documents like your PAN copy and then self attestation and then address proof. And then there was one in-person verification also for some time, where the person had to come to your house and look at you, and then you had to invest. So compared to that, today it's become quite easy.
All of that is online now.
Yes, yes.
Like in this webinar, everything is video based.
Correct.
Right? So that's a big advantage.
Yeah. And as you say, once you invest,
that's really the norm. Like we look around us, and it is ever evolving, because like I mentioned earlier, and which is the reality, that the customer today expects everything at a click, for lack of words, or by touching a couple of buttons on the screen. So as financial services industries, all of us are also evolving in line with the customer expectation.
Right. So today, to an investor looking to start on his mutual fund investments, there are three kinds of platforms which are available. First is, you can go through a mutual fund distributor and he will do all the processing for you. Or you can go to the AMC itself, and the website itself allows you to invest. And the third possibility is all these new fintech platforms which actually accept direct investments, like not regular plan, but direct plan without commissions, right? So what are the pros and cons of each of these, and what sort of investors should prefer each one? Can you just take us through that?
Yeah. So the long and short answer is that all are great, right? As long as you start your mutual fund journey, okay, these are just routes to start your mutual fund journey, depending upon the investor profile, in terms of if the investor is well researched, really understands the whole the product well, has the time, patience, and ability, more than anything, to decipher or kind of decode various various nuances associated with the financial products. Of course, the direct option is an option for such kind of investors. At the same time, there is large value in most advisors that advise, or most distributors who connect with people to kind of decode this for people. So, and and look at providing the right service. So that option is also there. Digital today is ubiquitous. So the most of it is available online today. So people can also look at a lot of these fintech players who kind of put everything, whatever you could do in the offline world is now online. And there are advantages for people who would want to look at the this mode of investing. I mean, I spoke largely on the pros. Cons, again, ma'am, it is very individual and very investor specific. So one should weigh these options and look at all the options before really deciding on the route, is what I would say.
Perhaps selecting the right fund is almost as difficult as selecting the right stock. So, if you feel that you're not well equipped to do the homework that is necessary, then you may have to take some kind of advice, or because in that case, then the wealth creation will be better rather than taking your own calls to choose.
Yeah. So yeah, also more than that, financial planning, which is really which is a word used most often, but practiced the least amount of time. Today, very clearly, if I have to go from maybe Mailapur to Tambaram, right, I would intuitively pull out my Google map and have, right. But if you ask a lot of investors, in 10 years, where do you want to reach? What's your goal? And what's the route that you're taking? Not a lot of people really invest time or patience to put out a financial plan. So the starting point for everything is a financial plan, and it is very important to have that. And
Yeah.
And the necessary condition for a financial plan is to really have a clear goal of what do I
Yes.
want to make out of my money 10 years down the line, 5 years down the line. Life cycle expenses are real, right? I mean, all of us are definitely going to grow old, right? Most of us would have various expenses as we grow old, and be it daughter's education or marriage in the family, health expenses, house upgrade, car upgrade. And somewhere we know that at 2 years down the line, this is the kind of money that I'm going to need. 5 years down the line, this is the kind of money I'm going to need. Or 10 years down the line, or post retirement, this is the kind of lifestyle I want to maintain. And this is what. But it is very important for one to really put it on paper, and then look at how much each of this thing is going to cost 10 years, 5 years down the line, because inflation is real. Whatever a Honda City costs today is not going to cost the same 3 years or 4 years down the line. And calculate, identify the goal, then set aside some amount every month, which is where the disciplined approach comes, into a fund that really gives those kind of returns, etc., and then stick to it. So I think whichever route one chooses, very important to really know the journey and the destination that one wants to go, rather than just blindly taking out your car and driving around to go to the Amram.
That's a good analogy, because we take many investor queries in BusinessLine portfolio, and the query that we get most often from first-time investors: I have selected these 4 funds, are they good? So each time we start the answer by saying, what is the purpose for which you're investing? What is your horizon? If you need money for within 3 years, then equity should not be your choice. If you have 10 years plus, then so this process of mapping out your goals, having an asset allocation plan, having your risk profile in mind, all of this is very important, though it sounds very boring compared to just picking the nice funds and outperforming with your portfolio. Right?
But ma'am, look at it. I mean, on the contrary, while financial planning sounds very boring, and most people, I would not say all, but most people really get switched off. So to say, when it comes to numbers, when it comes to planning, when it comes to really envisaging. But look at it on the other side, and I will just give you an anecdote. It doesn't necessarily apply to everybody, but I was talking to a group of young people on campus, and I asked this question in terms of do you have a financial plan? Do you have your goals mapped out? And like you mentioned, those boring questions that boring financial people like us talk. And of course, the group was switched off, and you could get a lot of blank stares in saying that what is this person talking about. So I then I just spoke to them about, hey, look, what do you think is and that time it was iPhone 10 versus iPhone 11. Is iPhone 10 better or 11? And the group really lit up in terms of no, 10 has got these features, 11 has got those features, you should buy that and this, etc. The amount of research each and every individual in that group and collectively as a group, they had done intuitively, about the features of an iPhone, right? And the amount of reading that must have gone, amount of engagement with the product that must have gone, it was phenomenal. And here you're talking only about a phone that's going to last for maybe 26 months, and on the other side, it is your own life journey. So that's the irony. So and the amount of discipline that people had put in going through each and every spec list or specification list of that product was nowhere compared to having any discipline towards financial planning or approach. And like the largest investor and one of the most richest person in the world, Warren Buffett, who's a legendary investor, says that it is definitely not about being smart or smarter than others to make money. It is about being more disciplined than others to make money. So while it all sounds boring, but boring is what makes money.
The other thing about mutual funds is basically this anytime liquidity, right? During this COVID times, actually, many of us have found that we have to face sudden medical emergencies or sudden problems with interruption in pay, etc. So we've had to actually raise funds very quickly at short notice. So this open-end funds offer this anytime liquidity through redemption. So compared to most other assets, whether it is real estate or gold or even stocks at times, it is not so easy to sell them because the price may be beaten down. So this feature of mutual funds is underappreciated, right? So once I place a redemption request, how soon can the fund actually credit the money in there?
So depends on the fund that you have. It is a liquid fund with an instant redemption facility. The redemption is almost immediate if it is below 50,000, right? Otherwise, anywhere between T+2 to T+3, which is, if I place a redemption today, within 2 to 3 working days, the money actually comes. And glad that you mentioned about the liquidity portion. I mean, a lot of people buy things like a house for an investment.
Yeah,
But
yeah.
when you really want to sell it and you want to find buyers, the cycle time required is so high. And if you want to shorten the cycle time, meaning if I want to really sell a house today, and if the market rate is say 100 rupees, okay, uh, I would, to get that buyer for 100 rupees, the time
Correct.
involved is very large. So most of the time, people then kind of sell it at a discount,
Correct.
because a lot of people who are hunting for deals give money immediately. So that's a very
Yeah.
important point that you made, and liquidity is very important when it comes to your own money. Perhaps that's why most of the time when people need money, they redeem only their mutual funds and do not look at selling other things.
Yes.
That's another point
Actually,
of financial planning or discipline in terms of investments. It is, one should not really look at just because it is convenient for me to redeem a mutual fund at a click of a button, and it's going to really come. One should really weigh that option in also, saying, is there any other option? Do I really look at money in my bank, FD, or do I look at any, and within mutual funds also, which is the category that I
yeah.
should redeem first, so that I don't really lose out on the returns accumulated and the power of compounding, because the more you stay is the more chance of you earning higher returns, because of the time in the market, right? And there again comes the whole asset allocation philosophy, saying that within mutual funds also, at any point in time, do I keep money in a liquid fund or a money market fund, so that if there is an
Correct.
emergency, I would just tap into it rather than shutting down all my investments.
Yeah. So equities, if you redeemed in March, you would be a real loser. So it would be good to have your emergency money in, say, a liquid fund or overnight fund, so that you don't have to interrupt your investments in equities, which are meant for the long term, right? That
Yes.
is what. Yes. So I think we're also running out of time. So one final thing, one important thing, even with mutual fund investors, is that you have to keep track of your portfolio to some extent. At least twice a year, you take a look at how your investments are performing. So,
Yeah.
what are some of the ways in which the investor can keep track of his or her investments? So, through the registrars or this cash statement, some of those things.
Absolutely. So a mutual fund house or a mutual fund company sends monthly statements in terms of what the portfolio is, portfolio value. Okay. To start with, I think as an industry, and since we are heavily regulated, and the regulator really works in favor of the customer, and all of us together ensure that there is customer centricity. There is something known as net asset value for every fund house, which is published every day. So mutual fund house actually takes a exam every day, and every day our report card is published. So one can go on a website and of a mutual fund house and find what is the value of that fund on a daily basis. Beyond that, on a monthly basis, there is a account statement that comes to investors. One can really look at it, and there's a large drill down. On a monthly basis, there is something known as a fund fact sheet or fact sheet, and that's a document which is available online, or you can walk into any AMC branch and get a hard copy as well, which has got a drill down of each and every fund portfolio, where the fund is invested, what is the kind of percentage in debt, equity, if it is a hybrid fund within an equity fund, what kind of sectors the fund is invested, what is the exposure, and what is the value of that fund as on that date. At the same time, the registrar also sends you a common account statement across your holding patterns. Apart from that, on the Association of Mutual Funds of India, which is AMFI website, there's a site called mutualfundsahihai.com, where you can really get fund comparison across various funds, fund houses, etc. So, I mean, basically, there is plethora of information available related to the industry or related to the whole instruments at a macro level. At the same time, there is individual information available at your fingertips to do with your own or our own portfolio. And like you mentioned, it is very, very, very important to keep on reviewing your portfolio at least once, twice, thrice a year, so that you really know where you're going in your financial journey.
So to summarize, we will move on to questions. So let me just summarize what we talked about. So in order to improve the return experience, there are 4 or 5 steps. First is that before you get to fund selection, please map out your goals, decide on the asset allocation, and decide on your own risk appetite, and then get to choosing funds. Second thing is stick to your asset allocation plan and financial plan through market conditions. Don't make drastic changes just because some category has outperformed or something has underperformed. Just stick to your journey in the way that you planned without making any detours. The third thing is, I find that many retail investors have this habit of chasing the assets which have outperformed in the recent past and ignoring the assets which have been underperforming. Please don't do that, because when you jump into the wrong asset at the wrong time, this really hampers your wealth creation journey. Do not overestimate your risk profile in a bull market and underestimate it in a bear market. So today, when you ask most investors how much risk can you take, because they've seen the market go up, they say, I can take a lot of risk. Please suggest 4 small cap funds. But when a fall comes, then you find that the person has overestimated their risk profile. So be realistic about how much of downside or loss that you can take before you buy any particular fund or category. Finally, investing in funds, also doing your due diligence, doing your homework on funds is very important before choosing. So if you're finding time to do it, you can take the direct route. But if you don't find the time, do look out for a qualified financial advisor who is registered with SEBI, and don't really try to save on the fee, because in the long run, the wealth creation impact can be quite substantial of making the right decisions. So with this summary, I'll move on to some of the interesting questions that have come. Abhijit, are you okay?
Yes.
Shall I just? Yeah.
Yes.
So Soumya is just asking, she's a research scholar entitled to a monthly stipend. So she's saying stipends often come late, so the income is not very smooth. So no, before we go on to the questions, I think there are a set of compliance slides to be run. I'm sorry. So we'll just take a shorter break and come back to the questions.
Okay.
Abhijit, excuse me. Yeah. Right. Thank you for your patience. I think we can go on to questions now. So Soumya Diol has a question. She's a research scholar and she gets a stipend, but the stipends are a little delayed and sometimes irregular. So she's asking Abhijit, if the flow is not smooth or reliable, can she still invest in mutual funds, and what are the options that she can look at?
Absolutely. I think, as and when there is investable surplus, uh, mutual fund investing is as easy. So you don't really have to give a standing instruction at a particular date, etc. Whenever there is money, you can look at various product options from a lump sum perspective. SIP is also a route that is there, but I understand. I mean, since the question is about irregular flows, there is an option that you can start an SIP and pause it
Okay.
for a particular period of time and then restart whenever the flows are there. So both options are available.
Yeah. Similarly, debt funds can be a good parking ground for such money also until you have saved up a substantial sum and can invest.
Yeah, that's definitely a valuable piece of advice.
Yeah, right. So Devendra is asking, currently the market P is close to 29.30. So is the Indian market really overvalued?
Oh, well, I mean, I think uh, while uh, while PE is one way of looking at the market, there are various other parameters. So like I was harping on the process orientation that we were talking about. Uh, any asset manager does not only look at markets from a one metric point of view. There are other parameters. The PE has to be looked at in conjunction with how the overall macro is going, what is the current account position of the country, what is the how is the economy growing, what are the opportunities. Again, within various sectors, a PE and PE can be really misleading in terms of if there is if a sector is overvalued with a high PE, then the story is different. But if a sector is undervalued, then the PEs can change as the economic conditions of that sector or the consumption demand on that sector, just as an example, goes through a cycle. So we would never comment on one metric, but look at a framework for investing in terms of price to equity, price to book as a metric, macroeconomic indicators that I spoke about, and every fund has a different objective. So these a lot of other factors play rather than PE. And
So I would
and
like to, yeah.
if anybody believes looking at everything the market's overvalued, and if that is the inference that or an informed decision that one's looking at, then again, like we spoke about, Aarti, asset allocation funds are a great option to look at, because that balance advantage fund or dynamic asset allocation fund then decide on the allocation between equity markets, debt markets, and the movement thereof on a dynamic model based automatic approach, so that investors capture the real essence of the market.
Yeah, since I don't belong to the AMC, I can give you a more direct answer. I do feel the market is a little expensive, the equity market, even if you look at other parameters. But the question is whether this PE will come down because earnings are going to rebound very sharply after COVID or not. So, in the last few years, the earnings projections have not come good very often. So, it is a time to be not over optimistic and to be a little cautious, and it is not also a time to go to zero equity. So you can manage it with the conservative asset allocation to equities or going through dynamic funds or hybrid equity funds. So I think that approach should be all right. And any money that you need within the next 3 years, it is best not to have it in equity funds today because the market is expensive.
Yeah, but
So,
if it is asset allocation or hybrid, I think
yeah, then,
yes.
yeah, yes. So Neeraj Kumar has this question saying recently FIIs have been buying continuously, but domestic institutions have been selling. So is this because of a lot of redemption pressure in mutual funds? So how should he interpret it?
Yeah, partially, yes. I mean, that's how the data shows. But the Indian investor is also mature now. In
Mm.
terms of not that the money that's redeemed is going away. A lot of people are looking at debt funds, or like we mentioned, dynamic asset allocation funds. So a lot of that, lot of people who have redeemed and booked profit are moving their asset allocations to other instruments. So on the whole, I think investors also realize that it is just not about buying and selling. It is about it is about making that intelligent switch, so that the money is growing at a particular pace, if not at a if the returns are not galloping, at least they are moving in the right direction rather than stopping.
Yeah. So we spoke a lot about rebalancing. So if your equity portion in your portfolio becomes very large, you have to move some of it to debt. So perhaps investors are actually acting, and if they have made a lot of money on their equity funds, there is no harm in their actually booking a little profit and rebalancing in favor of other assets which are undervalued, right? An anonymous person is asking how to make an effective mutual fund portfolio for beginners.
Yeah, I think, like I mentioned, the starting point is to have a plan, and then track that plan whether it is effective or not. For beginners, very important to get the asset allocation right. We suggest that look at balance advantage funds or asset allocation funds as a category, because that's where you get some investing experience, and basis that experience, then try to build a portfolio. And it is a continuous process, very very clearly. It is not that you do something now and then forget about it. It is a continuous process. You have to keep on evolving, and one has to keep on reviewing, and then adding money.
So one person is asking, do we follow the SIP route for debt or hybrid funds, or does it make sense compared to lump sum investments?
Yeah, see, again, SIP is an option, right? It's a feature. It is not
Yeah,
it's not an investment product as such. So
correct.
depending upon what is the investment horizon and surplus at hand, one can take that call. Having said which, of course, SIPs into hybrids also make a lot of sense,
Yeah,
because the SIP is not only about a product or investment class, but it is more about a disciplined approach towards entering a market and capturing various entry points, so that you can get the advantage of rupee cost averaging, because you enter at various points in time, your average kind of balances out. So yes, that is also an option that one can consider.
right. So there is a person asking, can you explain the difference between ETFs and index mutual funds?
Yeah, so exchange traded funds are largely funds which are baskets of companies or stocks, and there are uh, the baskets are particularly, so. For example, if there is a bank ETF, right? Uh, that ETF will pick up stocks within the banking sector as per the stipulated. For example, if there's a CPSC or Central Public
Yeah.
Sector Enterprises ETF, it will kind of pick stocks into only those companies at a predefined level, with a clear uh, information on at what point, is it once a year or more, will they rebalance the proportion of the companies that they take in that exchange traded fund. Index funds largely invest in various indices that are created by index makers like S&P or BSE, etc. And have a range of stocks in them.
So one key difference from the investor point of view, Prashant, is that for ETFs, actually, as an investor, you need to go to the stock market and actually buy it at the prevailing market price or sell it at the prevailing market price. So the mutual fund holds this predetermined basket of stocks, then it lists it on the exchange, and then you can transact only on the exchange as an individual. Whereas in the case of open-ended index funds, they are just like other funds, and you can go to the AMC itself and you can buy or sell units. So, and you need a demat account for an ETF, and you don't need it for an index mutual fund. So, from the investor point of view, this is the difference. Apart from what Vijit had actually explained. So. So one person is asking that even SIPs have seen a lot of redemption. Equity SIPs have seen a lot of redemption and profit booking. So how can you say that it is a disciplined way of investing?
Yeah, I mean, I completely agree with the question. A lot of people have stopped their SIPs. A lot of people have
Yeah.
moved from that. As long as that is in line with one's financial goal, Aarti, it is
Yeah.
perfectly the right thing to do. And like you mentioned in detail, it is not. I mean, entry or exit in the fund should not only be guided by how the broader markets are performing, but as long as it is in
Right.
line, it is a right thing to do. But if it is just believing that, oh, let me just get out, then then one might stand to have lose out on the power of compounding. Yeah.
So somebody is asking which is the correct way of profit booking. Should you redeem my entire holdings, or should I only redeem the excess amount over the invested amount?
Yeah, for that, again, one has to go back to your financial plan, investment objective. If there is a requirement of funds, uh, one should look at. But yes, the question is largely about, if it is about, and also one should consider taxation, Arthik, because
Yeah.
that's a very important
Yeah.
point, because
Yeah.
mutual funds are taxed, and there is long term capital gains as well as short term capital gains on various asset classes. So one should look at the taxation angle, consult one's tax consultant, or look at what one's tax liability is, and have that also as an important decision to redeem.
So one question from Jagmohan Kumar is, how do we select a good mid cap or small cap fund? I'm looking for a 15-year horizon, and I have an SIP running. So I think you can generically answer saying what is the due diligence you can choose for any mutual fund, right? So you look at its track record over a fairly long period. So many investors make this mistake of looking at the performance only for the last 1 year or last 3 years, but often both in debt and equities, the market cycle tends to be at least 10 years. So it is good that you look at the track record across an entire market cycle, and if possible, two market cycles, to see whether both in the up market and down market, the fund has performed equally well. You have to look at the mandate of the fund, whether it suits you, whether if you look at the performance in the previous bear markets and the amount of losses it has had, whether you have the risk appetite to take that loss. You can look at the current portfolio of the fund and whether you like the companies that are there in that. You look at the expense ratio or total expense TER of the fund, compare it to competitors, see whether you're getting good management at a reasonable fee. So these are some of the due diligence that you need to do while selecting a fund, and this applies to every fund, whether it's mid cap or small cap. There is not much difference.
Absolutely. Also look at, from a fund house philosophy, and that's very
Yeah,
important.
correct. Yes.
I mean, while you are selecting a product, it is not only important to look at the product in isolation, because it is not a commodity. It is it is investment is also about the science and art that goes behind managing money. So the philosophy of the fund house and your comfort with the fund house is also an important factor that one should look at. How has the fund house been performing over a period of time? what are the risks that the fund house is taken, and that's a very important aspect. While Aarti, you mentioned in terms of what are the losses or what are the market downtrend, notional again in terms of whether recovered or not recovered, but look at the risk management philosophy of the fund house. There is enough data available in the market in terms of not only mid cap, but on the debt side, how the fund house is performed, how much of the money has been performing, etc. Yeah.
So Raj Tilak has a nice question. He's saying he just got his first paycheck. So what percentage of his income should he invest in MFs, and what are the kind of products he should be choosing?
Well, I would say 100% in MFs, but depending upon your age, your time horizon, allocate it between debt, equity, hybrid as asset classes, and also look at balance advantage funds and dynamic asset allocation funds. I mean, it's and get the power of diversification, because
so as a person.
Fund houses give you an option across product spectrums. So that's the answer.
So what percentage of income, in the sense that I feel for beginners, you should aim to save at least 10% of your income. And if you're able to raise it to 15 or 20%, that would really be good, because it is not easy for people of this generation to save towards retirement, etc. So try to start with 10% of your income and put that in mutual funds, and then try to get it up to 15% or 20% as your income level improves. And to do this, actually,
I was saying that 100% of what
that I felt.
Yeah. I'm not saying that 100% of your
income. Yes. He's saying 100% of your amount that you save has to. Yes. So in this thing, actually, SIPs are very useful, because I found that if you have SIPs in the early part of the month, they get deducted from your account and you can't spend it. So it's a very useful way to have compulsory savings from your money.
Yeah,
because
point, Aarti. Again, I would want to quote Warren Buffett again. Where he says that do not save what is left after spending.
Yeah, save first.
Save. I mean, spend what is left after saving.
Saving, correct. Yeah.
So that's a very important philosophy to have from a disciplined investing point of view. That each month I will set aside this money towards my financial future, right? And then I will spend and adjust my spends. But in reality, people try to first spend everything, and then whatever is left, try to save. So a lot of people, when they say that, hey, look, I don't have money to save, I don't have money to put in mutual funds, how do I have expenses? I have to kind of invert the spend to save model.
Right. Now we do have a lot more questions, but unfortunately we are running out of time. I'll be sure to make a note of some of these questions so that we can write about it perhaps in BL Portfolio in future editions. So thank you so much, all of you, for joining us and for staying with us patiently through the last 1 hour and nearly 10 minutes. So thank you, Abhijit, for very patient answers to all the questions and for taking the time out to be on this webinar. Thank you so much.
Thank you very much, Aarti. It was really a pleasure. And, thank you for taking out this time to interact with investors. We really appreciate the effort that you put and the entire Hindu editorial team has put. Thank you very much.
Thank you. Yes.